Welcome to the ETF Market Insights, your regular webinar series that focuses on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights with the goal of helping you become an informed investor. Make sure to visit www.youtube.com/ETF Market Insights to watch previous episodes, and remember to hit subscribe so you receive a notification when we post new content. Thank you for joining us today. Let's get started.
Hi, I'm your host, Erin Allen with BMO ETFs. Welcome to today's episode. Today, we'll be taking a deep dive into low volatility ETFs. So we'll look at why less risk does not necessarily mean less return. We're going to explore the differences between the ETF options available here in Canada and the types of market environments these ETFs thrive in. Just a reminder, today we are not providing you any advice or investment recommendations. Today's episode is all about providing education around investing and around using ETFs for investors that are looking to take charge of their own portfolios. With me today is my colleague, Chris Heakes, portfolio manager of our low volatility suite of ETFs here at BMO, and Cam Gill, executive director of ETF services at CIBC Capital Markets. Thank you both for being here today.
Thanks, Aaron. Good to be here.
Good to have you. Before we get started, a reminder to check out our YouTube channel to watch any episodes that you may have missed. There's a range of topics there, so I highly encourage you to look through those. Remember to subscribe and make sure you ring that bell so that you're actually notified on future shows as we go live. Now, for today's 1-minute update, with the US announcing, and with this week in Canada, the announcement of sky-high inflation numbers, we saw that the Fed was prompted to really get aggressive on rate hikes, and they raised rates by 75 beeps, which definitely caused investors' fears to intensify. And this chart here is just showing that investors pulled $8.3 billion from US corporate bond funds last week. And if we look at the split there, it was mostly in high yield funds. They suffered net outflows of $6.6 billion, while investment grade funds lost $2.1 billion. And we're really just seeing investors there look to reallocate risk in their portfolios. Adding to that, there was record volume among fixed income ETFs last week as well. So a lot of trading activity on that front. Now, let's get into it. So as I mentioned, investors are definitely starting to feel the jitters, or continuing to feel the jitters, I should say, and it's a great time for us to be diving into the topic of low vol ETFs. I love the way your team, Cam, put it in a recent research report that they put out. Low vol ETFs are a less stressful journey to equity markets. Isn't that what we all need right now? If we look at behavioral finance studies around loss aversion, what's interesting to note is that we see that the people's fear of losing is psychologically twice as powerful as the pleasure that they get from gaining. And this is why we're seeing investors pulling money out of the markets right now. But in reality, they're doing themselves a disservice if they could just stay invested in a solution that could ease those bumps in the road. They'd be better off. Now, Chris, I want to turn it over to you. Let's get into low volatility investing and start with the basics. What do we mean by low volatility, and how does it compare to the other factors out
there? For sure. Thanks, Aaron, and great to be here again. So low volatility investing, it's part of what we call factor investing. What is factor investing? It's about taking a disciplined approach that differs from the broad market or the market cap index. Why is factor investing compelling? Like you said, it can solve problems for investors, investors who want equity exposure but want to reduce risk. Obviously, low volatility is a direction that, historically has been able to do that, and is obviously the focus of today's call. But in general, if you look at all the factors, the idea is improving upon either the returns versus the broad market, or lowering the risk versus the broad market, or in a perfect world doing both of those things. So it's about improving risk-adjusted returns. What we're showing on this scatter chart is the a long-term historical performance of the MSCI ACWI, so global equities, and you can see low vol is slightly improving on return, a little bit higher than the broad market, but significantly reducing risk. So whereas that average equity risk is 15%, you're looking at low volatility on this index closer to maybe call it 10.5%. So again, I think you've spoken to some of the benefits of lower volatility, but just to reiterate, it's really designed for investors who want to maintain that equity exposure, because we know, as you mentioned, fixed income's choppy. It's a little more attractive, but generally speaking, most investors need some equity in their portfolio to achieve those long-term growth targets. This is an approach that seeks to do that, but by its construction, which differs from the broad market, seeks to invest in more defensive, take a little bit less risk off the table. And what's a little bit interesting is it doesn't necessarily come at a return sacrifice, and in fact, often gives a market level returns or slightly higher. So that's what it's all about, and look forward to talking about it a little bit more today.
Perfect, thanks, Chris. Yeah, and this slide's going to sort of build on that. I'm hoping you can explain how we can actually measure volatility for a stock, and like you said, how the volatility investing sort of challenges that age-old belief that in order to get higher returns, you have to take on more risk.
Yeah, it's very interesting. But yeah, so we, when we're looking at constructing a factor, I think what you want to have is a disciplined process that's repeatable. You do it over time, because that's part of the benefit, is having a disciplined process. A lot of people engage in factor investing, but you want to have a disciplined process, and that means you need kind of some metrics to identify what is a low volatility stock versus a high volatility stock. There's lots of different approaches out in the market. We were the first provider to launch a low volatility strategy in Canada with the ZLB. And the approach we chose, and subsequently kind of expanded to the full suite of our low volatility offering now, is a low beta approach. And beta is a measurement of risk relative to the broad index. When you have betas less than 1, generally that's going to carry less systematic risk. When the betas are above 1, that's going to be more systematic risk. So what we do is we concentrate into those lower beta securities. We did a lot of testing. There's also standard deviation as another approach, or there's optimized approaches. There's different methodologies, but we really felt beta was, based on our research and our background on the quantitative side, this was the best approach to take. And as you can see, the results somewhat speak for themselves, right? So in Canada, ZLB, which I mentioned, is over 11 years, or coming up on 11 years of track record this year, versus the broad index, actually substantially adding to return, so almost over 4.5% of added return versus the index, coming at less risk, so measured by standard deviation, and a lower beta. You can see the same thing in the US. Well, the return is slightly less because we've had many years of kind of really strong equity growth in the US, slightly less return, but less volatility, less beta, better risk-adjusted returns. And certainly in these markets, when we're talking about volatility this year, ZLU is doing much better. It's outperforming the broad index by about 16% in 2022. So it's only down 3% this year, whereas the broad beta is down 19%. So again, great proof points of kind of the value that these strategies can add, as being a part of an overall equity allocation.
Mm-hmm. Definitely doing their job and smoothing the ride there. Next up, can you take us through this slide? Different factors perform differently in different economic environments. When does low vol typically outperform?
Yeah, so, we're seeing it right now is kind of the short answer. So, obviously in the last couple of weeks, this concern of recession is certainly hitting the markets, and it's hitting the markets, today as we discuss this and over the last couple of weeks. And so when those economic prospects are reducing, what you tend to see is the cyclical stocks get sold off. The more defensive stocks on a relative basis do better. So in markets like we're having, you know, kind of in 2022, they tend to do pretty good. And in fact, our strategies are, you know, what they tend to underperform when you have kind of that indiscriminate rally, and that maybe that characterizes a bit of what was happening coming out of COVID. It was kind of an indiscriminate rally, lots of stimulus into the market. What you'll see is low volatility is still going to give you some solid equity upside, but probably a little bit less than the broad market. But the real value added is in these kind of tough times and high volatility times where they can help protect capital. And what that does is just set you up in a better position to succeed for the long term. So markets like we're in right now with kind of fears of slowing growth and stagflation, you can see are you know, environments where low vol does typically quite well relative to the broad index.
Perfect. Thanks, Chris. Now, Cam, your team at CIBC has gone very deep on the low vol strategies available here in Canada and done some great research. There are many different ways to measure volatility, as Chris mentioned. On this slide, you're just showing the 3 Canadian equity low volatility ETF solutions. Can you walk us through this and the differences between what's available out there for investors?
Sure. So I guess first and foremost, thanks for having me and CIBC on this event today. And I do want to highlight that a lot of what I'll talk about is coming out of our research team that produces some good material, Jinyan in particular, with teams over Thai. Now, in terms of this table, it's probably worth mentioning or taking a step back and noting that low volatility, at least in my opinion, is a bit poorly defined as a factor. And just about every major low vol ETF defines its factor in a different way. And what that really means is you can really get something different from each of them. So, you know, they vary greatly in how they perform, especially in a choppy market. So with that in mind, I kind of note that there are probably 2 different categories for low vol factor ETFs. The first is a low vol ETF, and the second is a minimum vol ETF. They sound really similar to the average person, but they can actually be quite different. So to level set, it's obviously important to understand the differences before investing in any of them. So low vol ETFs tend to choose securities that meet some criteria that manufacturers such as BMO has defined as the proper way to look at the factor. So you should expect that you're basically buying a basket of stocks that individually have historically had a relatively calm price movement, especially in volatile periods. Whereas if you take a look at min vol funds, you're basically looking at a portfolio of securities that have been looked at in aggregate in order to reduce the volatility of the ETF. So within this table, the team's provided a brief description of the different methodologies for some of the Canadian listed funds. These are definitely the most prominent, BMO being probably the most. The variation in eligible universe, security selection, weighting, even rebalances provide a different result. In particular, we note that the iShares MinVol fund does some of what I described earlier, which is rather than screening by securities, it screens by or constructs a minimum variance portfolio within a set of constraints. Whereas by comparison, the BMO vol low vol lineup screens for securities, and it uses a 5-year beta, which tends to smooth things out pretty significantly. And the Invesco fund uses a 1-year price return volatility. Both of those funds are risk weighted. So yeah, you do get different things. And, you know, I didn't mention everything within this table itself, but it's worth highlighting that, you know, like any ETF, you really should spend some time considering what it holds and what strategy it deploys. And there are some active components overlaid on some of these funds on occasion, so it's important to know what you're getting into.
That's great. Thanks, Cam. Yeah, that's really important to look under the hood as the outcomes can be quite different, and we'll get into that a little bit more. We did have this slide as well. You mentioned on how it can basically create different exposures, whether you're looking at min vol or low vol. Let's take a look at sectors and dig a bit differently. How do the different methodologies work when it comes to sectors, and how can that impact the overall outcome of these products?
Sure. So, I think this slide does a really good job in highlighting how low vol kind of plays into Canada. It's pretty critical to note that the Canadian equity market is very different compared to the U.S. equity market. So strategies such as these can have a very impactful way in how you invest and the returns that you receive. So looking at this table, ZLB and TLV are both non-sector neutral, and what that means is they tend to deviate more from the base index from a sector allocation perspective. ZLB is capped at 35% per sector, but what you'll notice is that ZLB can opt out. So within this table, you see that ZLB has one less sector than the other funds, and that gives it a lot of flexibility to avoid sharper corners, if you want to call them that. ZLB in general can be materially overweight defensive sectors like consumer staples, utilities, and potentially underweight energy and financials, which tend to be more cyclical. TLV is also overweight at times, overweight less volatile sectors, but the portfolio composition looks very different due to the methodology that they deploy. So for example, small cap names are eligible within TLV. They also use shorter term metrics and screening, but that can also lead to higher turnover and more frequent rebalancing. So more trading within the fund itself that you might not see as an ETF holder. And as a comparison, it was about 20% overweight real estate just prior to the spring of 2020. I'm speaking to TLV. So volatility and REITs during that period drove pretty significant portfolio turnover within the next rebound period. The ZLB portfolio has been more stable due to the use of long-term metrics. I think that's, again, important to mention. The previous 5-year beta, or 5 years of beta, and less frequent rebalancing. So it trades less. It's effectively, the way that it's built, it's more committed to its strategy. ZLB and TLV returns are less correlated to the TSX as well, which I think is very interesting. XMV, on the other hand, takes a more sector neutral approach. It's generally, plus minus 5% versus the index. It's more appropriate for benchmark aware investors that want market-like returns and slightly lower vols. So if you go back to Chris's comments earlier, and he's talking about how these products perform in up versus down markets, XMV is probably going to normalize those returns in both directions. ZLB and XMV have both generated higher Sharpe ratios versus TSX, so they have outperformed, which is great, and investors have definitely taken note. And in most of the periods that we looked at, so whether it be short term or long term.
That's great. Thanks, Cam. I think Chris will get into more about why ZLB takes such a longer term look at beta and how that's a benefit to it. I know he was a big part of developing that product, and he'll have some things to say on that as well. On the next slide here, I like this slide because it's showing that these solutions are really delivering on their promise or their commitment. Can you walk us through how these ETFs have performed on a relative basis during market corrections and on a year-to-date basis?
Sure, of course. So I think you just highlighted it, Aaron, and Chris did earlier. In general, these funds outperform. So they have become very popular. They've gathered a lot in assets, and I think in general, coming out of volatile periods or periods of stress, they've actually gained more unit holders. So more people have kind of latched onto these funds. So again, just highlighting the great research that our team has done. We looked at 7 previous market corrections lasting over a month, and where we were down 10% or more. Most low vol ETFs outperformed the broader market in each of these periods, and notably by about 3 to 4% in Canada and 5 to 6% in the US. Interestingly, though, we thought that the low vol Canadian equity funds would underperform. given their lower exposure to the resource sectors, have been doing quite well recently. But this was mostly offset by their underweight tech positions. So again, focusing on the strategy itself, like what is low vol and min vol, what's it intended to do? It's to avoid volatility, and obviously tech tends to fall into that category. Also, in selecting the least volatile securities within each sector, it's contributed to positive returns. Our research report does a really good job looking at what we call the selection effect. And yeah, so it's really interesting to see. I'd also note that ZLB and ZLU typically have done slightly better versus its peers during corrections, and that's really based on the construction. So again, Aaron, you said it best: look under the hood, understand what you're getting, and what the manager might be doing, because that tends to lead to some performance. So on the next slide, there. You know, I'd probably mention that XMV is a top performer year to date, given its higher exposure to energy. So going back to the comment that I made earlier, XMV tends to align itself more closely with the index, which means that it tends to have more equal or balanced exposure across the different sectors. And since it has an exposure to energy, it was really able to benefit year to date. For US equities, low vol ETFs outperformed significantly, like especially ZLU versus the SPX. I believe it's about 16% year to date. So defensive sectors have held up really, really well, and products like ZLU have stood the I guess the test of time.
And done it all with little to no energy exposure. It's amazing. Now, this slide, a bit more on performance. Cam, I know we've looked a lot at performance, but I think this is powerful. The chart, especially on the bottom, that shows the volatility and how these solutions can help with that front. Can you walk us through this?
Yeah, of course. So I guess we're going to touch upon energy exposure again, but the big part of our performance versus the TSX from pre-2016 was primarily due to lower energy exposure. You know, these funds, if I can maybe put it a little bit differently, like in the way that the portfolios are structured, you're basically looking to avoid landmines, right? You're looking to avoid things that could potentially go down dramatically. And as a lot of listeners probably know, the energy space is quite volatile. So a lot of the outperformance pre-2016 came from then. ZLB versus TLV. ZLB's exposure to large cap, low beta names like consumer staples and discretionary sectors drove most of the outperformance. TLV typically has more exposure to smaller cap names, like I said earlier, which are not eligible for ZLB. And you know, as some listeners might expect, smaller cap names can have larger volatility at times, depending on what sector. Versus XMV, ZLB's you know, outperformance is primarily driven by its higher weight in renewable utilities and lower weight in energy. So again, just highlighting how sector weightings play out within these different products is really, really interesting. You know, the earliest comment I made was around, you know, they sound the same, but they're actually quite different. And I think the sector allocation is really what drives it. So on the other hand, you know, this was slightly offset by ZLB's lower weight in financials, which have definitely performed well. So, you know, in terms of the difference between the ETFs and their fund flows and their performance, there's definitely a difference between products. In general, they've all done relatively well. ZLB and ZLU have outperformed. And fund flows, they've really just been juggernauts in terms of, you know, gathering followers, right? Like I suggested, during periods of stress, they've had the opportunity to shine and demonstrate that their construction and strategy do work well. And as such, they've really grown.
Perfect. Thanks, Cam. I really appreciate you sharing all of the research from your team on CIBC. Chris, I want to turn it back to you. I don't know if you prefer the godfather or the OG of low vol ETFs in Canada, but you were a big part of developing these products. So walk us through the BMO ETF low vol process.
Yeah, for sure. Thanks. Yeah, no, it was, it was something that came out of kind of our institutional side of investing. We researched it, kind of leveraged some of our quant database to really come up with what we thought was a methodology that was going to work effectively and deliver on, the objectives clients have for these strategies. But just to, it's a relatively simple methodology. It starts with obviously a universe. As Cam mentioned, in Canada, we skew a little bit more larger cap. Those kind of top 100 or so companies in Canada is where we want to hold our target number of names. In US, EFI, and EM, we use large cap universes to select our names. What we do is we rank those securities by the beta, so that metric described earlier, as Cam said, as well as a 5-year window. It's a relatively stable metric. We think it gives a good indication and consistent indication on kind of what type of company a company is. Is it really a high risk or is it a lower risk? Having a longer data window really helps you, avoid kind of data eccentricities. So we do that, and what we seek to do is really, risk weight that portfolio. So we have a target number of names in Canada. Let's use Canada as an example, 45 names. We want to hold, the 45 lowest beta names, and I think that's really what differentiates the portfolio. There's different ways to create factor portfolios, as we discussed. But the way I think about it is you can have a pure factor approach, which in this case is identifying those low volatility stocks and skewing the weight towards them. Or you can have an approach that's more like market cap like, where you kind of take like tilting bets around the market cap. So I would call, that like a market cap tilt approach, and then there's a pure approach. So the way we do it is very much a pure approach. And I think when it comes to low volatility, there's a couple big benefits. So the two things that you want to get out of a low vol portfolio, as I mentioned before, capital preservation is kind of number one when markets are highly volatile like they are today. And by having a pure approach, it can be more skewed to those defensive sectors that really tend to outperform better when volatility is high. So again, that pure approach tends to work well because you get a little bit more capital preservation. And then on the other side, on the return side of the equation, we've kind of talked about it, but the low volatility anomaly, that these lower risk stocks don't necessarily sacrifice on return. It's like, yes, energy has periods where it returns, a lot like it is this year, but over the long term, it's actually these kind of more, call them plain vanilla type stocks, slow and steady type stocks, actually offer a better kind of return over the long period of time. So again, by having that pure approach, you get more exposure to that kind of low volatility anomaly, as we call it. We do have sector caps and country caps in the international portfolio to ensure that the sector skews don't get too large. So we have some intelligent capping there, and we rebalance the portfolio semi-annually. And again, just to emphasize, it's a disciplined process. It's not to say we oversee it and we oversee the construction as portfolio managers, but the discipline of the approach, I think, is definitely a benefit. And it's that approach, for example, Shopify, we don't hold any energy in ZLB. That's been a little bit of a drag, but for example, Shopify, a lot of people were chasing returns with Shopify. It just simply didn't meet the framework of the low vol construction. And so we never held Shopify. And if you look at what we've made by not holding Shopify, that's actually balanced out versus energy. And now with this kind of recent kind of tick up in risk, the drawdown this year on the index is about 9% in Canada, and we're only down 5 on the low vol. And as we discussed in the US one, that difference is even more staggering. So it really helps investors manage risk in their portfolios, but still keeping equity exposure. And again, it's a win by not losing approach, having that capital preservation and setting up for future success.
Awesome. Thanks, Chris. Can you walk us through the different options that we have available at BMO ETFs? We've talked a lot about ZLB, but what else do we have available for investors?
For sure. So yeah, Canada and US are kind of the largest. The ZLB was, as I mentioned, the first one, launched in 2011, and has a great, as we saw, return history since then. In the US, we have unhedged, hedged, and .U units. So the ZLU would be our unhedged. We have the ZLH, which is a hedged, and with US dollar trading units as well, if you have US dollars in your account. And yeah, not to reiterate the point, but performing very well, where we're seeing growth in the U.S. taking a big step back with these interest rate hikes, and speculative stocks taking a step back in light of the volatility, the low volatility strategy, very strong there. And then we've got international EFI markets, international markets with ZLI and ZLD. ZLD would be the hedged one, and we also offer emerging markets as well with the ZLE.
Perfect. Thanks, Chris. Now, I want to turn to our audience questions. Please keep submitting them. They're great for us to figure out what's on your mind and giving us new ideas for shows. So let's get into some of them. Chris, I will ask you this one. Are there BMO ETFs with no correlation to the equity markets? I'm interested in an ETF that generates yield from alternative sectors to equity markets, such as real estate or alternative assets, to protect my portfolio.
Yeah, great question. And it's been a challenging market this year because typically fixed income is your kind of gives you that correlation benefit versus equities, gives you diversification. As we know, that the start to the year on fixed income has been one of the worst in 30, 40 years. That being said, in recent weeks, I would say it's trading a little bit more normal, in the sense of when equities go down, fixed income goes up. Earlier in the year, equities were down, fixed income was also down. So typically it would be fixed income is where you look. One idea off the desk is our short corporate bond. So investment grade bonds. I think you want to be mindful of where we are in the cycle, but these are investment grade bonds and they're yielding approximately 4.5% right now on the ZCS, very low fee product. So that's one. In terms of other alternative assets, a couple of more defensive options. We mentioned the ZLU. Just to give you some risk numbers, the volatility is 12% on ZLU versus 18% on the index this year. The correlation is about a 0.5. Another one is global infrastructure, ZGI, and I don't have the number in front of me, but I believe it's positive for the year, 4 to 5% positive, which is pretty good for equities this year. It's got a lower correlation. Infrastructure can offer, partial hedge to inflation as well. So that's one to look at. And, maybe, a gold ETF like a ZGD, or you could look at gold as a potential hedge in the portfolio as well. So a couple ideas there.
Perfect. Thanks. Yeah, we talked about commodity ETFs last week, and we kind of dove deep into the correlation around those as well. So something to check out if you're interested in learning more on that front around gold and things. Next question, Chris, what are cover call ETFs? How do they work? I heard a speaker mention them a few weeks back. Yes, I think Chris was on a few weeks back, but I'll throw you this one, Chris. Hopefully you can quickly touch on what cover call ETFs are and how they work.
Yeah, for sure. So, cover call ETFs, it's for, clients who want a little bit more income out of those equity exposure. Our cover call strategies are going to generate an extra target kind of 3 to 5% of option premiums, tax efficient, tax as capital gain or ROC, and that's in addition to whatever the dividend yield is on those underlying equities. But really, yeah, it's just about getting a little more income out of it. One nice thing is cover calls tend to monetize the volatility that's in the market. So, when volatility is elevated like it is, cover calls can give you that ability to take advantage of it a bit. We have a lot of cover calls. But I would, I guess the one thing to think of when you're looking at cover calls is look at the underlying portfolio first, because that's really what drives the risk. So you want to be comfortable with that. I just wanted to mention, our dividend-based cover calls, our high dividend-based cover calls, they're not quite low vol portfolios, but they share some of those same characteristics. High quality, blue chip dividend payers, they're going to be a little bit less risk on that risk spectrum. So they've got a little bit of that low volatility flavor to them. And that can work well. So when you compare a good underlying strategy with that cover call overlay to increase the income, I think that's where they can be kind of, good fits in the portfolio. So again, if you're looking for a little more income, still want equity growth, that would, probably these solutions could work well for you.
Right. And I think with cover call ETFs, just like with low vol ETFs, look under the hood because they're all constructed totally differently from what is that underlying portfolio, and if there's any quality type screens on that portfolio, how much of the portfolio is being written on, how far out of the money the options are. All of these things are going to impact the outcome of those solutions as well. The last question is in respect to BMO's socially responsible ETFs, how are the companies within the ETF selected and by what criteria are they selected and how often are they rebalanced? So I can take this one. We have a number of different responsible ETFs at BMO, but I will focus on the equity related ones that we have that track the MSCI ESG Leaders Index. These are sort of our more popular ESG solutions. And these ETFs invest in companies really that have the highest environmental, social, and governance ESG performance in each sector of the parent index. So these are sector neutral products where we choose the companies with the highest MSCI ESG rating in each of the sectors. So you will see an energy exposure, for example, in these ESG products. I could probably spend an hour getting into how MSCI actually evaluates the companies based on ESG risks. They look at factors that are material to the particular sector that the company is in, which is interesting. But we do have a whole episode focused on this that does dive deeper as well. So again, go to YouTube, type in ESG on the Market Insights channel, and you will get sort of a deep dive around this topic if you're interested in learning more. With regards to rebalancing, the ESG equity ETFs are rebalanced on a quarterly basis. So that caps off another great week of ETF Market Insights. Thank you very much for tuning in, and thank you to Chris and Cam for joining me today. Next Friday is Canada Day, and we'll be taking a break. We'll be returning live on Friday, July 8th, and we'll be discussing technical analysis, which is an investment technique that really looks to evaluate investments and identify opportunities in the markets based on price trends and patterns that are seen in charts. So very interesting stuff. I'll be joined by Colin Cieszynski from SIA Wealth and my colleague Alfred Lee, Portfolio Manager at BMO ETFs. So I hope you can all join us then. Happy early Canada Day. Bye for now.
Thank you for watching the Market Insights webinar series. To stream any previous episode of the Market Insights webinar series, please visit www.youtube.com/ETF Market Insights. Remember to hit subscribe so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at www.etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or a recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.